Welcome again to another installment of American IRA's IRA Cafe webinar series. This is our live webinar today, and we're so happy to have our guest today who's going to share some vital information if you are looking to do any leveraging inside of your retirement account with real estate and asset classes like that. So a couple of housekeeping deals. I am Kyle Moody with American IRA. I'm in the business development office. I see some names here that I get to talk to quite often. And for those of you who I haven't had a chance to speak with yet, my phone line is always open for you and always looking to be able to share the education and the information for you to be able to move forward with your own self-directed IRA with American IRA here. And we are looking forward to having you on as a client. So one other thing, I want to go through our disclaimer really quick. This presentation is for educational purposes only. American IRA, headquartered in Asheville, North Carolina, is a neutral third-party administrator on behalf of the custodian New Vision Trust Company, a state charter trust company based in South Dakota, and does not offer investment advice or endorsements. We are not responsible for statements made by others. References to we and us refer to American IRA only. We encourage you to do your own due diligence and consult with qualified professionals before making any investment decisions. Well, without further delay, I'm going to go ahead and introduce our guest today, Ryan Hughes. He is the owner of Non-Recourse Loan. And not just that company being new here in the past year, but Ryan has an extensive background in banking and how he has been able to help a number of our clients and others realize being able to leverage inside their retirement account when purchasing real estate. So remember that if you are looking at buying real estate inside of your IRA or Roth or whichever asset vehicle that you do have, if you don't have the 100% funds to purchase that, you can still move forward with the purchase. And a non-recourse loan is the only type of loan that you can get when using a self-directed IRA. And Ryan is a wonderful resource to be able to explain it, give you all the ins and outs of it, and then also be able to assist you if you need to set up that type of lending. So we are going to have time for questions at the end of the presentation. Feel free to put those in the chat box and we will get to those at the end. So without further ado, Ryan, again, welcome to the show. I'm going to turn my camera off and my mic off, and the stage is all yours.
Well, thanks, Kyle. I appreciate you having me on again, and welcome to everyone that's joined us. As Kyle mentioned, I own nonrecoursloan.com, and again, Ryan Hughes here. So I have a couple slides we can go through, and then definitely I'll open up for Q&A and any questions that come up throughout my presentation. Please, like Kyle mentioned, put them in chat. This is for education, as Kyle mentioned, earlier. So just definitely check with your attorney, tax professional, if you decide to do this within your IRA, because just in terms of tax implications and how to structure it properly. And of course, American IRA is a resource when you decide to do this. Just make sure you let them know what you're doing so they can properly advise you on the structure of it, and they can record it properly with the record keeping and everything you need to do from that point. So what is a non-recourse loan? That's a lot of questions get, how do I borrow with an IRA, or can I borrow with an IRA, or oh my goodness, I was going to buy a house and I bought it inside a regular traditional loan. And that's where you just can't have any personal liability. That's bottom line. That's the difference of a traditional loan versus a loan inside of an IRA or a 401k, is you just can't personally sign for it. You can't be liable because then that's self-dealing. So just there's rules around that. So that's basically all it is it's strictly secured by the property, there's no personal liability. So that's the biggest thing of a non-recourse, basically no personal liability. So that's the same thing as, they're the same. It's just strictly based on the actual collateral of the property, not you personally. So that's the definition of a non-recourse loan. Why does it matter? So again, like I said, there's no personal guarantees in the IRS rules. You can't personally guarantee any type of when you're borrowing or leveraging inside your retirement. So that's why it matters. And that's, the IRS sets that up for you. So you can't do that. And then it's, we make sure the non-recourse, it is compliant. So it is an IRS compliant loan. It allows you to leverage, with your real estate. So like Kyle mentioned, if you're buying a $300,000 house and you don't have it, this allows you to borrow, 50, 60% of that asset. And so, borrow the difference and then put down your IRA for the down payment and closing costs. That is important. Make sure you don't put down closing costs, personally. It has to be all from your actual IRA. So again, the benefits, it allows you to leverage your retirement. It's compliant with the IRS rules, and it also shields your personal assets from your liability, which is important. So if something were to happen, this asset is still protected. Of course, check with your attorney, but it's underneath the protection rules. So if something does happen, this is part of your retirement, not personally, which is very important. So it belongs to your IRA, not you personally. So it's a pretty easy process. Obviously first you have to find a property. I say it's easy, but that tends to be the hardest part of this, is finding a property that, that qualifies in terms of the debt coverage, which is your that it's basically the debt coverage is based on the property itself versus you personally. So you don't use your W-2 or your self-employment income. We qualify based on the actual asset itself. So what you'll do is once you find that property, you'll submit a property worksheet. We'll pre-approve it. This actually can be done online. We're rolling out a whole new system, which should go live next week. If you want to check us out, you can actually get pre-approved and look and make sure that property qualifies, or you can run some scenarios through the website. Just if you want to just play around and see what you can purchase, that will go live next week. So you'll have real-time access to that as well. So you tell us what you want to buy, the type of property, the address, if you have it, the purchase price, how much money. The most important part is how much money you have in your IRA, because the down payment is typically anywhere from 30 to 50%, depending on which lender you go with. And so that's most important. It is a substantial down payment compared to the traditional lending. So it's, 10, 15, 20% more than what you would typically have on an investment property. So just be aware of that. Plus you have closing costs, and typically there are some reserve requirements, which we could go into that a little more detailed at the end. So we'll get the property information. We'll go ahead and review it, see if it qualifies mainly based on the down payment and the debt coverage, which is the DSCR. It's called a debt service coverage ratio. There's a lot of loans out there for investments, and that's based on the net income of the rental minus expenses, and whatever's left over, you have to have 125% of your principal and interest payment. So basically, if you have $1,000 principal and interest payment on that loan, your net income has to be $1,250. So just as an example. Of course, we'll get the application in. We do a pretty traditional application just to make sure we know who you are. We do have to verify the KYC, know your customer. So we're not doing a loan to someone that's not who you say you are. So we do verify that. And then of course we get the appraisal deposit, order the appraisal. That takes a couple weeks. And then, so we'll do that as well. Once the appraisal comes in, we'll review it. Of course, our underwriting it's pretty easy underwriting. There's not a lot required since there is no personal liability. And then once we have that in, which is typically about 2 to 3 weeks for this process, and then we can go ahead and get it scheduled for closing with the title company and get the loan closed. So typically the process is normally like a standard loan, 4 to 5 weeks is a pretty good estimate on what we typically from start to finish to close the loan. So that's really the process for this. The loan amounts are anywhere from as low as 50,000. Now, again, this is general. We typically most lenders want to be around 100,000 on the loan amount minimum. Some are 150, some are 250. So that's something you want to check with the lenders. And typically 2 million is about the max that we see out there. Some can go higher, but just whoever you're speaking to, make sure you verify that with the lender. No credit score. We do want to see the credit score just mainly for credit worthiness. So we don't, the credit score doesn't determine the rate or the terms, but we do want to make sure there's no major credit, tax liens is the biggest part. So we do want to look at that, whoever's the sponsor, the trustee is actually, or the manager of the IRA is, has some credit worthiness on that. Again, no personal guaranteed. And then what proper information is needed. Like I said, typically, again, verify this with your lender, but most of the time it's single family, 1 to 4 units. We will consider condos, townhomes, of course, are no problem. Commercial's pretty limited, so just be aware of that. If you have a commercial property or you want to purchase commercial, definitely check with a lender you're using. And normally you have to have experience when it comes to commercial property. So if you don't have experience, most of the time that's going to be very difficult, and you're going to have to put down about 50% normally on those type transactions. Of course, we want the purchase price, estimated value. We're going to go off the lower of the two, so the appraised value or the purchase price on the property. That's what we're going to base the value on. The income, I say, don't, when you figure the income, make sure you check with a realtor, the market. Of course, you can look at Zillow and Redfin, but just use a average, not the lowest rental, but not the highest. So just somewhere in the a medium for that. And then of course, if it has an actual tenant in there, then use the lease, whatever lease is actually in place. Most of the time, some lenders want you to have a lease, by the way. So just be aware of that. Just again, check with who you're working with. We're okay either or, if you have a tenant in there or if there's not. So because a lot of times when you're buying it, there's not one in there. And of course, the property condition, typically 1940 and newer. If it's older than some of the in the East Coast, there are some older properties. Just be aware of that if it's older than 1940, it's been renovated. There may be an additional inspection required. So just just be aware of that. And then also no major repairs. And typically, if there's any more than 10% of the property value, so 100,000 hours, if there's more than 10,000 hours in repairs, just then there may be some. Just want to check with the lender on that, because none of us really want major repairs on that property, on that asset. And then it's also, so check that. And then also it's mostly cosmetic. So anything like paint, carpet, that kind of stuff is not a problem. Of course, the operating expenses, HOA, if it is a condo, you're going to want to get the covenants from the HOA association. So the homeowner association, you want to get their covenants, make sure there's no, especially now with what's going on in the market, there's a lot of HOAs that are changing their policies. They don't have insurance in place. They're high deductibles with everything going on in a lot of the coastline properties. So just be aware that it's getting more difficult to get those properties financed. But then taxes, insurance, we don't necessarily need the utilities, but it's good that you want to have that. We mostly care about the management fee, the vacancy, which we most of the time typically figure about an 8% vacancy, which is a little high in the market, but that's what we use. And then the ownership structure, how it's the name of your IRA, FBO, American IRA, and then the actual name of the IRA, how it's going to be titled. And then, so just make sure you have all that information, the entity docs, and Kyle can help with that as well, with the actual entity docs. I'm putting that words in his mouth, but I'm assuming he can help with that as with the title of the actual 401k or the IRA. So that's really about it in terms of what's needed on the properties. And then I don't know if we have any questions. I mean, I kind of went through this pretty quickly, but the biggest part is identifying the property, and then let's go ahead and get it pre-approved to see if the property qualifies. At that point, then we can go from there. But number one is if you have a down payment, that's the key. I see most people, when they call me, okay, I found a property, but they're thinking 20% down and you need 30 or 40% down. And then it doesn't work. So you spent this time out there shopping. But so just the biggest part is the down payment and the closing costs. Well, I guess this is probably the most important part. So the compliance consideration, when you buy a property and use leverage inside your IRA, there is the UBIT. So if you leverage, well, it's actually UDFI. So when you are debt financing with your IRA, then you could be have tax on that. So if you say you borrow $50,000 on a $100,000 property, that $50,000 when you sell it, so half of that property, you sell that property for $200,000. Well, now $100,000 of that $200,000 that you sold it for, that profit is 50% of that is taxable. So just to check with your ERISA attorney, of course, for that. But that's one thing you got to be aware of on when you purchase and use leverage inside for an IRA. Then you could be, there could be that taxable event. So just be aware of that. But that's the biggest part about the UDFI is always make sure you figure that in, because you do have to actually pay that tax on your return. So that's all I have for the slides, Kyle.
Ryan, we greatly appreciate it. Thank you for coming back. And if anybody is listening to any of our podcasts out there, if you're not yet, we welcome you to start. There's a lot of great guests, a lot of great information shared there as well. And Ryan is actually going to be a podcast guest coming up here shortly as well. So you'll want to make sure to catch that. You might hear some of this information again and something that he hasn't covered yet. So again, wherever and whenever you are listening to us on your Wednesday here, we thank you. We value you, and we greatly appreciate your business and your attention. And we like to make sure we bring you the best information and education possible. And with that, make sure that you join us next week when we have Rob Stanley with Shining Rock Equity, who's going to be joining us at the same time at noon Eastern next Wednesday. So for everyone here at American IRA, we thank you, and we will see you next time on the IRA Cafe webinar series. Bye now.